Let's get to today's action with our market panel. Charlie Bobrinskoy of Ariel Investments and Adam Crisafulli of Vital Knowledge. Guys, good to see you. Adam, so was that broadening of the rally a few weeks ago, that rotation into small caps, a head fake, you think?
I think we've obviously had a big rebound led by tech, and so we'll kind of have to see if the data cooperates going forward. We've had some decent growth numbers last week with retail sales and the latest weekly claims. We're going to get an important jobs revision tomorrow. That will be very important just to get a sense of how the labor market unfolded over the last 12 months, over the last year or so. But I do think that the rally going forward will continue to broaden out. It's just a little bit of a pullback, give back in small caps in the Russell as tech reasserts its leadership. But, I don't think what we saw was a head fake so long as we continue along on the present trajectory of Goldilocks data, Fed easing, and then resilient corporate earnings.
Well, I know, Charlie, you are waiting for value to reassert itself after long being dormant. And then where do the Fed cuts that we are expecting fit into this? They matter for the yield curve, but you say the yield curve, we can put that to bed, doesn't matter as a recession indicator.
Yeah, I think you have to understand that we've had a very strange yield curve. We've had a short rates at 5.5%. with 10-year rates down below 4 at 380. And that's very unusual. And that has a big impact on an important part of the value universe, which is finance, banks, and investment banks. And banks and investment banks fundamentally borrow short and lend long. And they get hurt with inverted yield curves. And that has been a big headwind for value. We expect that to flatten out and return to a normal shaped yield curve. And that's going to be very good for banks, which will be good for value.
And what do you expect the implications are? And I'm reading through value here, Charlie, for smaller cap stocks, which tend to operate more based on lending.
No, that's right. The big Amazon and Google and Facebook and the like don't care about interest rates. They don't tend to borrow much at all. The traditional economy, manufacturing and finance and banks do tend to have some leverage. And they have been hurt by this very strange fastest, unprecedented increase in interest rates that we got over the last couple of years. So as that unwinds, that's going to disproportionately help smaller companies, which do have more leverage than larger companies.
So, Adam, following through on that, we got Jackson Hole this week, next week NVIDIA earnings. Question for me out of both is whether smaller cap stocks can grab the microphone back from the mega caps after they've reasserted themselves over this period of time, and how much NVIDIA's results are going to matter for that question.
Yeah, I think NVIDIA is crucial. I think it's probably going to be more important than Powell's speech this Friday at Jackson Hole, which will probably be somewhat anticlimactic. Fed officials have been relatively clear that they're likely to cut 25 basis points next month. I think Powell will kind of reinforce that notion. Where there's a little bit more doubt is on the mega cap tech front. Now, we've had some healthy earnings so far from the July end tech companies with Cisco and Palo Alto, but NVIDIA is going to be crucial as we get a sense of, whether or not the very aggressive AI data center spending is going to continue in the second half of this calendar year. We're going to get an update on their Blackwell chip if that's going to ship in time at the end of this calendar year. It's going to be delayed a little bit. So I think that's the NVIDIA report. And then we also have a lot of other AI names like Dell and Marvell next week also. Those are going to be Dell's next week. And those are going to be crucial data points for the tech trade.
So, Charlie, we don't know exactly what's going to happen with the consumer. We certainly don't know what's going to happen with the presidential election. But what are a couple of the most important themes that are determining how you put new money to work over these next few weeks?
We want to look for things that are out of favor, that have temporary headwinds that will benefit from a reversion to the mean. And the big one on that front is housing. We have not built enough housing. People haven't been able to finance housing because of mortgage rates. At the end of COVID, we had a lot of people moving out of their parents' bedrooms, and so there is a shortage of housing. That is going to be helped by what happens in Jackson Hole, we think, with lower rates, and that's going to help housing stocks, carpet stocks, roofing stocks, all the people that benefit from not just new homes, but repair and remodel, which has also got pent-up demand.